paid 3 years worth, you might only be able to take one, and you'll have to, it's almost like an amortization at that point.
How would you be able to deduct that the next year?
I think it would have to do with how the contract was written. I think that's where you would probably have to, if you have to pay it up front in order to keep the contract, I think at that point you're probably looking at it. You're probably looking at wanting to amortize it, one, for consistency's sake, to match the expense up a little bit. Although I honestly don't know.
So somehow you could like depreciate.
Basically, that's what you'd be looking at.
Okay.
Kind of like loan fees a little bit. I would look at it. You know, you have to amortize it over the, you know, the life of the loan or whatever. That's kind of how I would look at that. But I can't say for certain with any amount of certainty on that. That's just kind of off the top of my head what I think would happen. I'd have to do a little bit of research.
What do you suppose with the guy at the other end that's accepting that?
See, that would be the other side of
Am I
it.
gonna give him a 1099 for?
See, and that would be the other side of it. If you want to deduct it in the year you pay all 3 years worth, send a 1099 for everything.
Is that
Which
happening?
Well, you just hear of auctions.
All up front?
Yeah.
some of it is. I've heard that a little bit too. I haven't run into any of it obviously, just because I haven't gotten the question
Right,
before.
yeah, neither of them.
But you know, I heard stories of land down by Geddes not too long ago, cash renting out for $450 or $460 an acre. You know,
For a 3-year time period.
for a 3-year time period.
Not all the money up front.
I don't know if that was up front or not, but I have heard of those leases where they want all the money up front. I've had it.
There was a little bit up front, you know, in that one. 30 years.
And I don't know if that's considered almost like a deposit, or if, you know, if it's a portion, if it's only 10% up front, you know, 10% of the next 2 years up front, we're probably running it through this year. But for prepaid rents, you know, if it's something where you've got the contract and I'm gonna pay you next year's rent now, that's kind of where we're looking at here. We haven't seen a whole lot of these 3 years worth of pay up front yet, so I think there's more coming probably, but. The production deduction, this is something that actually came out of 9/11, is actually where this started. And where it started was they were trying to get people to reinvest. They were trying to get contractors to start building again. They were trying to get people just to reinvest their money into manufacturing is primarily where it started. Well, somehow when the law got written, farmers got included as manufacturing and construction. So what it is if you pay wages, you can take, this year it's 9% of your net income as a deduction. Where we see a lot more of it is pass-throughs from CHS, South Dakota Wheat Growers. Those are probably the two big ones. You'll get it on your 1099, and it'll have a number down there that's called the production deduction. It just flows right through to your return. It's just a tax credit, basically. How it's calculated, and I've got a slide, I think, that shows kind of how it's calculated. It's limited to 50% of the wages paid. But if you look here, and it's kind of hard to read. Whoops, wrong one. 50,000 of wage farm income nets a deduction of $4,500. So your actual net taxable income is $45,500. With the tax without the deduction is basically $6,700. The tax with the deduction goes down to basically $600. It's about a $675 savings. Now you have to have wages in order to take it, and it's limited to 50% of the wages. Where a lot of our smaller smaller is probably not the right word, but our single individual producers who don't have any wages get the benefit of it, is flow-throughs from South Dakota Wheat Growers, from these cooperatives that are taking it at the cooperative level, and then they're passing it through to you. Now, if you do have wages and you're calculating the production deduction, you have to take out anything that you sold to any of those entities. So I think the main ones I've seen are Wheat Growers, CHS, Country Pride, I believe. Those are probably the three big ones. I think whatever the one over by Freeman, Cargill maybe, whichever one over by Freeman. There's a co-op over there that's got it too. But you'll get on your 1099, there'll be a box that says per unit retainage. And basically what that is the grain that you sold to them that they use to calculate your portion of the production deduction, and you can't use it to calculate yours is what it is. So when it started, it was only 3%, and there were a lot of people that said the calculations and the machinations weren't worth the deduction. Now it's 9%. I think it's worth it. So, charitable gifts of raised commodities. Here's your slide. What this is you can gift, kind of like your spouse wages, your commodity wages. You can gift to whoever you want, really. In order for it to be a deduction, it's got to be a charitable organization. Your church, United Way, whatever you want to do. A lot of times we see it with churches. But what you can do is you can gift so many bushels of grain to the church. So you go into town with a weigh slip, you get your load weighed, and you say 500 bushels of this corn is the church's. What happens is it never gets reported on yours, so you don't report the income. The church gets the donation, and you actually, by not reporting the income, get a deduction that you would not get normally. Because most individuals' charitable giving does not reach the level that gets them over the standard deduction. Between their medical expenses, their charitable giving, and their real estate taxes and house interest, it doesn't get them over the standard deduction. So they don't get any benefit of this giving. By doing it this way, it reduces your income. You've saved income tax, you've saved self-employment tax, and the church still gets their money. Now, just like the commodity wages, you cannot go to the elevator, say this 500 bushel is the church's, send them a check. You need to go in, you need to say this 500 bushels is the church's, they will be contacting you to sell it. Where that comes into play, they can still ask you for advice. They can say, when should I sell it? The pastor can say, I don't know anything about grain, when should I sell it? When should I market it? Type of a thing. But they need to have that responsibility, and they need to have that burden placed on them. You also need some sort of evidence that it was transferred to them. It can be a weigh slip with a signature that says, I have gifted you this many bushels of corn, beans, whatever. You need to contact the elevator to sell it, type of a thing. Questions?
Yeah, keep talking more.
That's really, that's kind of it in a nutshell. Because of the higher standard deduction, people don't get the charitable deductions. A lot of farmers say, well, yeah, but then I don't, or people say, yeah, but then I don't have anything to put in the plate. Put an envelope with a slip that says you're getting some grain, it's coming. If you want to put something in every month or every week or whatever. But
Okay, my comment on that was, back in November when we had our meeting back in November.
Okay.
You went before crop insurance, yeah?
Yes.
Farm credit services. Or they went before you.
she went before me, and she
Yeah,
said
we
it
were
screws
out.
up their
Yeah,
it screws up their crop insurance. I've heard that argument before. I've also heard crop insurance people say that as long as you've got a copy of the weigh slip that says it was given to the church, it should not matter. It kind of depends a little bit, I think, on the company.
So, the reason I'm asking that is because I was with an audit,
Sure.
with one of my guys, and, that auditor basically said that, they couldn't use any of those scale tickets that went to the church.
See,
And
and
they had the copy.
I honestly don't have the answer for you on that, because to me, that's a crop insurance issue. It doesn't make sense to me, because you've got proof of the production. That's where I don't know, I'm not 100% sure there. And maybe it does, maybe that becomes a factor in your decision, and maybe you say, you know what, it doesn't matter, I'll just give the gift of cash and not take the deduction. I do know that this is a way to reduce your income, save some tax, and also make your charitable contribution that you would have made anyway.
So if you're gonna do that, just don't give a semi-load of corn off of a 15-acre field.
Right.
Do it on if you're not in enterprise, if you're in
Right. And it kind of depends on what your gift wants to be, at whatever beans were, 15 something at one point. It doesn't take many bushels to get to $1,000 gift or a $1,500 gift, if that's what you want to give, type of a thing. And this year was kind of an odd year just because of the lack of production, but in spots.
Well, that was my argument, or our argument, the farmer's my argument was. that
Did you win?
Uh, he had more issues than that.
You have more proof there than if you're feeding wet corn to livestock.
Right, and
You
I don't
what mean?
know.
At least there, you have a ticket. If I got 400 head of cattle on feed and I'm cutting green shop or ear leech,
Right.
what really proof do I have there, period? Other than I have this many cattle on feed.
And that's what I don't know. I honestly don't know enough about the crop insurance audit side of it to prove, you know.
You gotta weigh every load or have an average weight of your loads and then,
They'd probably have
For
to
what?
come and adjust it
Yeah.
before you could
Feeding?
chop it.
yeah, well, for chopping, they're either gonna adjust it before you chop it, or if to prove your deal, you have to have an average weight of every load, and they have a calculation for your, what that was.
I've never had that issue. We've done it many.
See, and like I said, I don't know what the crop insurance audit side of it. I just know from the tax side of it, you're better off doing this than giving them a check. Just because you're saving income tax, you're saving self-employment tax. So if it's $1,000 gift, you're saving at least $150 just in self-employment tax. So, but if it screws up your crop insurance yields and screws up your crop insurance payouts, maybe it's not worth it. You know, that I honestly don't know. But I think he's probably got a pretty good point too.
Oh, right.
You've got a better record with a weight ticket that you
Yeah.
gave to the church than you do feeding wet corn out of the field.
Yeah, and that was kind of the argument, and
So-
that was just a point I wanted to make, so that,
Right, and like I said, I probably should add that in here just for information purposes. I probably need to make a note to add that into my slide for next year too, just because there are other considerations other than income taxes, and it's a very good point.
And I mean, insurance and FSA is not interested in coming out and doing several appraisals.
Right.
If you're feeding it as you're taking it out.
Sure,
I mean, they have zero interest in doing that.
sure,
So-
I can understand that too.
Because what we've been told is just basically write up, I fed this many bushel of corn to this many cattle over this period of time, as long as it makes sense.
Sure. And I think this is probably a situation where the crop insurance companies this year are taking a beating, and so they're trying to bite back a little bit, I think. You know, I think that's probably part of what's going on too, a little bit, so. But yeah, from a tax standpoint, this is better than writing the check. But from a business standpoint or from a crop insurance standpoint, it may not be. So, very good point. This has actually changed a little bit. I kind of forgot about this slide when I was going through. This has changed slightly just because you can completely ignore that schedule to the side, to your right side. It's basically gone, if your income tax bracket is 10, 15, 28, 33, or 35, the max is gonna be 15%. If you happen to get up into that 39% bracket, it's gonna be 20%. If you're in the 15% bracket or below, it's 0. So, it's actually very similar to what this is showing right here, right now. This is changed to 13 as well, and 15% is if it's higher than the 15% bracket up to the 35. Which I think the top of the 35 is where that 400 if you're single, 450 if you're married, filing jointly starts. So, holding periods. To get long-term capital gain treatments, you need to hold it for more than 12 months unless it is breeding livestock, and then it needs to be 24 months. Typically where that would come into play is the sale of raised cull heifers. That's where we see it the most, raised cull cattle. Now, if your business is to typically sell bred heifers, that is just like if you were selling fat calves. That does not get capital gains treatment. Installment sales, we touched on them briefly. Capital gains on installment sales, the one thing I will mention on capital gains on installment sales is if you sell real property and do a installment sale, you can elect to pay the tax all in the first year. We had a few people that were probably going to do that this year because we didn't know what capital gains rates were gonna do. They might change their mind now that capital gains rates have changed, but that's a decision we don't have to make until we file the returns. So, installment sales of what they call Section 1245 property. What this is single-purpose facilities, which would be grain bins, cattle barns, farm machinery, purchase breeding stock, any of that stuff is always ordinary income in the year of the sale of the gain, regardless of how much cash is collected. So the situation I had with that, I had a father who, he was done really farming, sold some equipment to his boys, but they didn't want to pay for it all, and I think it was $100,000 that we had kind of settled on for the purchase price. They were going to pay him $10,000 a year apiece for 5 years. Well, because of the income tax capital gains rules, we didn't know what was going to happen. Hindsight's 20/20, maybe we should have kept it, but we took the gain all in the year of the sale, and actually he had to because it was equipment. We have to take the gain all in the year of the sale, even though he's not getting all of the income, just because that type of property has to be all picked up in the year of the sale. So, and then there's some special rules for related party sales if it's sold within 2 years of the original sale, which if you get to that situation, talk to your accountant. Sale of residence within a farm sale. As you may or may not know, you get a $250,000 gain exclusion for the sale of personal residence. And actually it must be $500,000 now if you're joint. It's $250,000 single. The rules are you have to have owned the residence for more than 2 years out of the last 5. You have to have occupied it for more than 2 years out of the last 5. And you haven't used a gain exclusion in more than 2 years preceding the sale date. So what that means is if you sell let's just say you sell the acreage, you sell everything, you can, the adjacent vacant land, so basically your acreage, whether it's farm or not, say you own 13 acres on an acreage, you can exclude up to $500,000 of that sale. Now you gotta pull the buildings out and do some allocation for the buildings, but if you're married filing jointly, you can exclude up to $500,000 on that sale. So even if the land is sold for $10,000 an acre and you've got, this huge gain, you do have some exclusion for that usually. So, I believe this is the last couple of slides, farm income averaging. What this is this is available to farmers only as well, and you have to be an active farmer engaged in farming or business, and it only affects the current year income tax calculation. It does not affect self-employment tax, it does not affect AMT, it does not affect kitty tax. But self-employment tax should be a consideration in this, because what you can do is if you have a really good year, or say for instance this year you got a $500,000 crop insurance check, and we don't have any idea what's going to happen next year. In the last few years you haven't had a very good year. Say you've shown 10%, you're in the 10% income bracket, or even 50. You've made about $70,000 a year. What you can do is you can elect to take all that income, and then you can elect to push it all back into prior years and tax at the prior year income tax bracket. What it does is it averages it out over those years, shifts the brackets, and calculates the income tax on that dollar amount. Now, it does not affect self-employment tax, but the consideration is once you hit $106,000 of income, actually it's $110,200 this year, I think, you are only subject to 2.9% Medicare tax. You are no longer subject to the 13% of Social Security tax, or 12.4, I think it is, 6.2 twice 12.4. You're no longer subject to that. You've blown through the limit. Now, you're going to write a big check either way. I mean, 15% or even 13% on $110,000 is roughly a $14,000 check. But every dollar earned after that's only at 2.9% instead of the 15.5. Here's the calculation. I don't know how good it's going to show up. It's really small. But what I did was, if you look at it here, taxable income here is for 2012 was $170,000. In the prior 3 years, what I had done was I kept it, and I created the example so I could kind of do whatever I wanted with the math. But we were at about 35,000 of income, 30 to 35,000 of each of the prior 3 years. So what we could do is we could take 100,000 and shift it back over the last 3 years. And the purpose for the numbers was I was trying to keep everybody every year in the 15% bracket. That was the reason for it. 2009 you're at 65,000, 2010 you're at 67, 2011 you're at 68, 2012 you're at 70. So the income tax on the 2012 number, the 70 is 10.5. In 2011, it's roughly 10,000 for every one of them. But you get to take off the tax you paid originally. So it's roughly another 15,000 in tax. So your total income tax liability, if you income average with this 100,000, is $25,000. The tax without income averaging would have been $34,000. So you're saving $9,000. Now the other side of that is the Social Security and Medicare tax. If you would have paid tax on each one of those years with consistent income, you would have paid basically $10,000 a year, or roughly $40,000. If you do it the way it was originally computed, oh, sorry, I'm reading that wrong. Here's the one that I actually really wanted to show you. Consistently, it would have been roughly $40,000. However, if you do it the way with the farm income averaging, it's only 30. You're saving roughly $7,700 in Social Security taxes as well. So total taxes without averaging for 2012 would have been $73,000. The taxes with averaging was roughly $56,000, saving you almost $17,000 in income tax. Now, like I said, the check is pretty big, but even looking over at your Social Security over the prior 3 years, you're paying more in Social Security tax each year because it's up higher on each of those years. So, and that is it. Any other questions? Anything I went over too fast or skipped over that you wanted to hear?
Okay, I got a scenario for you. It's gonna be pretty general,
Okay.
but it applies. Okay, I'll tell you my own scenario here. I work at vet clinic in Parkson as well as farm with my dad.
Okay.
Had a calf. Basically, the gist of it was exposed to rabies.
Okay.
Had to go and get the post-exposure rabies shots as well as pre-exposure. Whatever, I think it's 4,000.
For you, or for the calf?
No, for me.
For you,
For
okay.
me, because I was exposed
Yep.
to.
Yep. Okay. Just making sure. I just want to make sure I'm
Yeah.
got all the information.
The calf got a bullet.
That's what I figured, but
Basically, is that deductible?
I would say, once again, that kind of falls under the gray area, but I would not be uncomfortable taking it.
Okay, what would I take that under then? Would I take it under miscellaneous? Or?
I would probably say some more sort of miscellaneous expense. However, you could also call it some sort of work-related medical expense, almost like a work comp expense, if you would. Most of the time, we don't see work comp on Schedule Fs, but
I thought I should be able to take it because if I was working for the vet clinic,
they would pay for it.
They would have to pay for it, and then they would definitely take it.
See, and that's why I would not be completely uncomfortable with taking it.
Okay.
Wording on what it was, we'd hammer that out when we did the return. But it would be I would either call it a miscellaneous expense or some sort of work-related medical. From that standpoint, or work-related vaccination or something along that lines.
Okay.
And actually, you could even, if you wanted to put rabies exposure shots on the description if you wanted
Okay.
to. Depending on how big your miscellaneous expenses normally are.
Yeah,
I'd
I don't
probably-
think I want to take it under miscellaneous.
It's kind of a case-by-case basis, The key with the IRS is consistency.
Yeah,
You want to make sure you're consistent. And if something's out of the ordinary, you kind of want to make sure you specify why. And I would maybe even put rabies vaccination shots.
Okay.
And they may not even look at it because, to be perfectly honest with you, a lot of those people wouldn't know whether that was for you or for a calf anyway. So, to be perfectly
It's
honest, I
an
mean,
expensive bull apparently.
well, yeah, but I would, I don't think I would feel uncomfortable taking it. So, but that's just kind of me, I guess. It's kind of on a case-by-case basis a little bit, how you're comfortable your preparer would be with it. I mean, it's probably a little bit gray, but there's an expense incurred because of work. It was not something that it was
Yeah.
not just a regular medical expense
Yeah.
type of a thing, so. Anything else? Well, thank you very much for allowing me to talk. I think I probably went longer than I was supposed to, but.
Thanks, Jonathan.
You bet, thank you.
We said in the introduction, if you have any question, if you wanna
I'll hang around for a little
have
bit.
Jonathan do some income tax work for you, it's in the annual report under ELO. And as far as related to, this kinda wraps up session 1 in Mitchell. For session 2, which is in 2 weeks, you guys come here by 9:50 and ready to go by 10, that's perfectly fine. We're gonna, it would be helpful for you to go into your Fury manual, okay? And look over session 2, it's the balance sheet stuff. We'll start session 2 with an estate planning person and business organization structure, a lawyer at Mitchell. And then in the afternoon session, we'll get into section 2, with balance sheet information. We're gonna go over the FSA forms, the 2037 and 2038. And that'll be session 2. Any questions or thoughts? We'll be in this room, so we can pretty well finish up the taping and shut that off. Some of you had a comment or two, I'm gonna miss a session because of a wholesale or something going on, something